And good morning once again, options traders. Well, this is a really important video. I've wanted to post it for a long time, but I did it in response to a conversation with another trader who actually had a strangle, which is a call and a put, different strikes. And he thought, well, if I keep rolling the call out, I can eventually recoup some money. And it certainly seems to make sense on the surface. Hey, every time I roll, I'm getting some cash back and it's reducing the cost of this position. But that's really missing the point of the roll. And so let's answer this question. Would it be possible to have a position and just roll yourself into profitability? It's a good question. Let's go find out. And before we do, as always, please be sure to click like and subscribe. It is always very much appreciated and goes a long way into supporting the channel. So quick review. Remember what rolling is. It's just a technique that we use for calls or puts. And what it means is that you are going to switch or to roll two different strikes or expirations. So there's many types of rolls. You can roll a position up. That's where you're moving from a lower strike to a higher strike. You can move it down or roll it down. You can roll it in. When we use the word in, it means you're bringing it to a closer date. So maybe you're moving it from March to January. And then of course we can roll it out. Just the opposite, maybe rolling from January out to March. And then of course there's all kinds of combinations where we could be rolling down and in or up and out and things. But for this video, really what this trader was talking about was simply rolling up. So remember the purpose of that. Let's say that you have the $100 call and here's our risk graph. We've paid $6 for it. We roll it. We sell our $100 call to close. We buy the 105. And the reason that we do this is that it shifts this red curve higher. It reduces the amount that you can lose. Now, of course, there is a trade-off. You're going to increase that break-even point a little bit. Now, the reason I said a little bit in this example is because this was done for a $4 credit. And we can see that here. We had an initial cost of $6. We now have a net cost of $2. So we must have received $4 and that $1 balance. Okay, we're rolling from the 100 to the 105, so it's a $5 roll. If we get a $4 credit, that $1 balance must show up right here. We had to increase the break-even point by $1. And of course, what we're eventually trying to do is to maybe roll ourselves into profitability where the entire curve sits above zero. So again, that was really this trader's question. Whether you just bought, let's say, a call option, or maybe you've had it for days or weeks, could you just start rolling it and get a significant part of your money back, maybe even all of it? Or better yet, could you roll yourself into profitability? So maybe you've got this call that's currently trading for 7. We roll it to the 105 call that's trading for 5. And of course, we get a $2 credit. And then we turn around and we roll the 105 call to the 110 that's trading for 350. So we get a $1.50 credit. And the question is, are all of these credits eventually going to make up that $7 cost? Can you eventually roll into profitability? And once again, it's a good question, so let's jump over to an Excel spreadsheet and take a look at a pricing model. All right, so now here's our Excel spreadsheet, and these numbers here, these option prices, were generated from a pricing model. I used the stock at 100. I think I had 25% volatility and no interest rates, but that doesn't really matter. You're going to get exactly the same outcomes, just with different numbers. So we've got different strikes. And according to this pricing model, under these conditions, the 80 strike was trading for $20.70, the 85 strike for $16.46, and so on, all the way down the line. So let's say that we have this $80 call, and it doesn't matter if we just bought it or maybe we've been holding it for a while, maybe it's appreciated, whatever, but right now it's trading for $20.70. And we want to see if we could roll into profitability. So the pricing model says the 85 call is worth $16.46. If I roll it, I can collect $20.70 for selling my 80, and I can pay $16.46 for buying the 85. And that's going to give me a credit of $4.24, what we call the marginal difference. It's just the incremental difference between those two. So I would put $4.24 into my pocket. But wait, why stop there? Let's roll the 85 to the 90. The 90 is trading for $12.69, so again, same thing. I can receive $16.46 by closing this position. I can pay $12.69, and I can sweep 377 into my pocket. That's what this person was thinking. I can continually capture some credits, and that's reducing my cost. Well, look what happens if we go far enough. If we go all the way down to where the option's eventually trading for 0, and we add up all of these credits you would get, look at that, 2070. It's exactly the same as the price where you started, and that will always be true. I'll show you why in a minute. There's a mathematical reason for this, but that will always be true. Now over here in the cumulative column is a little different look. It's just looking at the sum of all of these. So in other words, this second row right here, 801, is taking 424 plus 377. What this means is that at this point, you would have collected a total of 801, 424 plus 377. When you roll down here for 321, when you roll to the 95, you would have a total of 1123, and so on, and look at that total. You eventually hit a limit of $20.70, exactly the price where you started. So why does this happen? It's a little tricky to see because the numbers are so disjointed. But let's take a look at a simple example. If we just count from 1 to 6, all right, think about what's happening. We are moving from 1, we're ending up at 6. So that kind of tells you that these numbers in between are just stepping stones that are leading you to 6. So each of the individual steps must take you to 6. So look what happens. If we look at the marginals, going from 1 to 2 is an increase of 1. Going from 2 to 3 is an increase of 1, and so on all the way up to 6. If we add these numbers up, that's 5, plus our starting point is 6. Now we can make it more complicated, and in fact we don't even have to just increase. Watch, I could go from 1 to 5, drop down to 2, increase to 4, 7, and 12. Look at the marginals. Going from 1 to 5 is an increase of 4. From 5 to 2 is a decrease of 3. We go all the way down the list. Now add up all of these numbers. 4 minus 3 is 1, plus 2 is 3, plus 3 is 6, plus 5 is 11, plus this one right here takes you right back to 12. So see, that's always going to be true. The fact is, we went from this price down to this price. These were just stepping stones to get there. And so it doesn't matter which parameters you use for your pricing model. Yeah, you'll get different prices, but you're always going to get the same outcome, that you cannot roll to profitability. That would just be too good to be true. Buy the option, turn around and just continually roll it until you got profits. That would just be an awesome options market, but again, never going to happen. Now also notice something that I was assuming, just to really make the point, is that under ideal conditions, all right, we were assuming that the stock price never moved, that time didn't move, we did all of these rolls within a second, volatility didn't move. The very best you could do is just get your money back. In the real world, you've got bid-ask spreads, you've got commissions, so you're never, ever going to have this happen, especially if you're waiting for a day or two before you're doing these rolls. Now, again, some people might say, well, you know, it's not so bad. We at least got our money back. Well, that's not looking at it the right way. You could have, back here when you bought this option for 2070, just rolled it straight here. Why go through all of the steps? Or even if you didn't just pay 2070, you wanted to roll, there's no reason to take all of the individual steps. If you want to go from the 80 call to the 100, just roll to the 100. You're not going to gain a benefit by rolling to the 85, then to the 90, then to the 95, and then to the 100. You're going to get exactly the same amount of money, again, assuming no bid-ask spreads and no commissions. So I hope that that really shows why you can't roll into profitability. And yet it's something that so many people fall for when they're trading, and you can kind of see why. So for instance, this trader had a strangle, risk graph looked like this, and of course he's paid a lot of money for it, right? Because he had to pay for a call and a put. So he was thinking, hey, if I can roll this call out, maybe to the 110 strike and then to the 115, and I can collect all of these credits, I can reduce the cost. But think about why that's definitely not going to work for a strangle. We saw it wouldn't work for just the call because the very best you're going to do is just recoup the money of the call. But you've got to recoup it for the call and the put. But every time you do this for the strangle, you're just pushing that break-even point out further, paying commissions, paying a bid-ask spread, and you're just digging a deeper hole. So if you're ever wondering, can you roll to profitability? You've heard me talk about it before where I say you should always roll. Well, it depends. The answer is yes, you can if the stock is making significant and favorable moves. You got to have both of those conditions. It's got to be moving in your favor, meaning up for calls or down for puts, but they can't just be small. You can't say, well, the stock's up 50 cents, let me roll it. But the thing to understand is that your profits never come just from the rolling for the reasons that we just saw. The profits actually come from favorable stock moves. The rolling instead hedges the risk by sweeping money from the position. So that's an important point to understand, and I hope it helps you to make better decisions. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsa2z.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.